You know, the market's finally going back up, but it continues to narrow. You look at the NYSE, over the last 15 years, half the companies on it have decided to delist. Trillions of dollars of asset value voted with their feet. Where are they going? Private equity. Yeah, private equity. It's not just for Gordon Gekko anymore, and in some instances, it may be for you and for me. I'm Fred Croft. I'm Chief Investment Officer at RAR Capital Partners, and this is an RAR Capital concept. If we're thinking about private equity investment, we need to think about how does this work? Why is private equity a good category? There's a number of reasons for it. One of which is when it buys companies, it gets a unique asset. The asset is time. If you're running a public company, you're basically reacting to things every 15 minutes. This means you end up being very tactical. If you're running a private equity company, you got a little more ability to be strategic. That means you can think more about what you're doing. You're operating on a 3 to 5 year horizon. That gives you a bunch of profit opportunities that really aren't there for the guys in the public markets. You also got the second element. You got focus. When you're public, everybody's got an opinion. The media, your shareholders, your employees, your golf buddies. When you're private equity, it's a lot more focused. You can kind of concentrate on the core job. The core job being, I bought a company for X, and I'm selling it for X plus down the road. And that brings us to the one other thing you do have to evaluate private equity companies on. Private equity fund has to do one thing very well. Think about exits. When you're buying something, you need to be thinking about it in terms of this is a relationship, not a marriage. I'm coming in, I'm going to accomplish certain things, I'm going to get out and lock in my profits. You don't see people doing that in public markets all the time because they think they've got all this flexibility. That's a plus and it's a minus. The one thing it does for you that I like on the private equity side is it really forces you to think about what are reasonable expectations. That has value. But with all these positives, there are a couple of negatives you need to keep in mind as well. First of which we just talked about. Liquidity. When people are on the public markets, more or less, they figure, yeah, I can buy and sell whenever I feel like it. That's sort of true. At the same token, you can buy and sell whenever you like, but you can't necessarily make money when you're doing it. So if you're really managing for profitability, you need to think about when am I going out, even if I am public. But private equity forces that issue up front. Other thing you have to think about as an investment manager is valuation. You buy public stock, you're getting a valuation every 15 seconds as the screen refreshes. If you're in private equity, you haven't got that immediate feedback loop. So you need to be thinking a lot more about how do I measure where my investment is, how do I measure what it's worth, all of the kind of technical valuation issues. That said, a lot of folks have made a lot of money in private equity. I've been in the field, God, 3 decades now, and I've never seen a decade where plenty of people were not making plenty of money. But you're sitting there thinking, well, that's great for them. I'm not Carl Icahn. How do I do this as a little guy? There are a couple of ways you can play at home. Let's walk through some. First off, let's take some of the large options. You got a couple of big companies that are actually pretty good. One of them is probably the marquee player in the industry, KKR. They're guys who were one of the founding fathers of the whole private equity movement. Solid management, they know what they're doing. They've got a public issue you can participate in. It throws off about 10% a year. It's not a bad thing. Other big one that you should take a look at is Carlyle. Carlyle's a little more specialized. It's pretty much focused on stuff that works with the government. Does a lot of aerospace, does a lot of military contractors, does a lot of kind of infrastructure-y type stuff. Carlyle is more narrow-focused, but it's well-run. They really know the field. They have good connections in Washington. That's another one you should take a look at. Now, some of you guys may want to say, I don't want to deal with the obvious colossi. I want to think about things that are a little smaller, where everybody's still got the fire to go after it. A couple of ones that we'd suggest you look at there. First of which, the thing called Compass Diversified Holdings. They invest in a lot of small and mid-sized deals, mostly manufacturing type companies. They've got an 8.5% preferred, strong balance sheet. That's a solid operation. The other one, if you don't mind overseas, is a thing on the London Exchange called Pantheon International. It's mostly a secondary private equity player. It buys pieces of other people's deals. Makes a lot of money when it does it. Over the last 10 years, it's done annual distributions, and it's pretty much kicking off about 11.5% a year. Now, it's probably not going to kick that off this year. We're going to see lesser returns, but that gives you kind of an opportunity here. Because right now, everybody's been anticipating that Pantheon's selling at a 30% discount to net asset value. That means you're getting a little less cash flow, but you got a heck of a lot of protection in terms of underlying solid assets. You also got protection in terms of cash. They've got a current market cap about £1.5 billion. 10% of that right now is in cash. That means if a deal goes in trouble, they got the money to fix it. If there's an opportunity that comes up, they got the money to buy it. So this may well be an opportunity for you as well. We think the whole private equity field right now is something to take a look at, and we're suggesting that there are still some opportunities out there. I'm Fred Croft, and I'm reminding you to stay skeptical, stay smart, and stay tuned.